Hello and welcome to my note, coming to you earlier in the day than usual because we have a bona fide surprise from the Fed to talk about. So you've no doubt noticed from the market reactions over the last few hours, people have been very surprised by the latest words from Bernanke of the Federal Reserve. He says that the risks to the downside of the US economy are diminishing, and people are taking that as a clear sign that he is now trying to start the process of tightening after the long period of easy monetary policy. Now, changing the direction of a central bank can be rather like changing the direction of a supertanker. So says my guest today, who is the FT's blogger and also the principal of Fulcrum Asset Management, Gavyn Davies. Gavyn, thanks very much for joining me once more. Now, one fascinating chart that you gave us in your blog this morning concerns the US employment market, which we all know is a very critical concern for Bernanke and the rest of the Fed. Take me through this chart.
Okay, well, I think what this really says to me is that the employment market has not really improved very much.
Right.
Two things. The unemployment rate has come down, the green line, but much of that has been because of a fall in the participation ratio, the red line. So people have been disappearing from the labour market, rather than a lot of new jobs really being created. Second thing is, if you look at the black line at the bottom, it's the employment ratio to the population, and that's hardly moved at all.
It's about as flat as it gets.
It's as flat as a pancake, right through the recovery. So the issue is, why is Chairman Bernanke tightening when the labour market is not really improving all that much?
Now, I have a further problem when I ask myself that question. If we take a look at the next chart, we all know that Bernanke is very worried about deflation. He's a great scholar of the Depression and of Japan. If we look at all of these measures of inflation and inflation expectations, commodities prices, his favourite measure, PCE on a core level, or break-evens from the tips market, all of them suggest that inflation is heading downwards, that we might be moving towards a risk for deflation.
Yes.
What am I missing here?
Nothing.
Okay.
What you've said is exactly right. He was asked at the press conference, given these numbers, why are you removing accommodation, or beginning to think about it anyway? And he didn't give a very good answer, John, to be honest. He said, well, we think a lot of this is temporary, and the longer term inflation expectations are still stable. But it's clear to me that he's decided to take a risk with inflation being too low, to a much greater extent than he did in 2010 or 11 in similar circumstances when he introduced more rounds of quantitative easing when this happened. So he's clearly changed, and the question is why. I think it's because he thinks the economy genuinely is improving this time, and unspoken, he's probably worried about asset market bubbles too.
Okay, now that's my other big theory I wanted to discuss with you. If we take a look at the final chart, this gives you an idea. We're looking at returns rather than yields for a change on the fixed interest instruments. Obviously, emerging market debt has had quite a sharp sell-off. Similarly, people losing money in treasuries. Has this all just been an attempt to talk the market down before we get a true asset bubble emerging, even if he denies it? Well,
I think some of it has been that. I think for Chairman Bernanke himself, this is probably not at the top of his agenda, but for some people on the FOMC it is. In 1994 and 2003, when they did something similar, those are the only two similar examples, the leveraged parts of the system came under big pressure. In 1994, it was the mortgage market. Equities actually didn't. They fell a little bit, but they didn't come under much pressure.
Precisely.
But the leveraged parts of the bond market, and this time it's the emerging bond markets, are, I think, in severe difficulty at this stage.
Final question. Do you think, it seems to me that the logic of where we've been discussing so far suggests that even if he says his base case is that he'll start tapering later this year, maybe September, and end tapering by the middle of next year, there has to be quite a considerable risk that it's actually going to happen later than that, doesn't it?
Much later, yeah. I mean, if you look at the employment data in the labour market, it is not improving fast enough to hit his unemployment thresholds very quickly. So I think if there's a risk of earlier or later tapering, it's more likely to be later than earlier.
Okay, Gavyn, thank you very much indeed. To sum up as quickly as best I can, it looks as though we might be in the middle of somewhat of an overreaction, but it's also possible that that's exactly what the Fed wanted. You can achieve a tightening just by getting bond yields to go up, and that is what has happened.